Hello, this is Jhaun Pryce, your real estate advocate, coming to you again. We're going to talk today a little bit about non-QM loans. What are non-QM loans? Non-QM loans are literally non-qualifying mortgages. These are mortgages that do not fit the guidelines of what we consider to be a conventional mortgage or a government-backed loan. And there's several different types. I have my little notepad here to go through with you with those different types. You have bank statement loans. Bank statement loans, DSCRs, or debt service coverage ratio loans. You also have non-tax ID loans, adjustable rate mortgages. I know they have a bad rap, but we briefly talk about those. And then foreign national loans. Now, keep in mind, these mortgages are for people that would ordinarily not fit the mold for a government-backed loan. That's either Fannie Mae, Freddie Mac, which we call conventional guidelines, FHA, or VA. Okay, so these loans are not necessarily in the high interest rate category, but they're in that in between. And so for a lot of people, like for example, the bank statement loans are mainly made for business owners. We all know a lot of times with business owners, when they do their tax returns, a lot of times you write off a lot of your debts. And so what ends up happening is that the lender is typically going to look at your adjusted gross income. That adjusted gross income is what lending uses, or the government, to determine whether or not you're going to qualify for a mortgage. If you have, let's say, $100,000 in income, but you've written off up to $80,000, that shows only $20,000 in income. A lot of times, for a lot of buyers, we can't help them in that situation. We also have the debt service coverage ratio loan. And so with those type of loans, what happens is the lender will look at the debt service of the particular property, i.e., whether or not the property can carry itself through rent. So for example, if your mortgage would ordinarily be $3,000 a month, the rentals in the neighborhood need to be at least $3,000 a month in order for you to get this loan. And so the lenders in those two types of loans, they're looking more at your assets, meaning whatever money you have in your account or your deposits in your bank account, in the case of the bank statement loans, to make a determination if you can qualify. We have non-tax ID loans. These are a lot of times for dreamers. I know you guys typically hear of dreamers or people that have gotten political asylum to the United States, and they may not have a social security number or a tax ID. And so a lot of times, even those people can get a mortgage. I've actually done a mortgage with a client that had that same situation. You have the American dream as well, not just anybody that has been born or raised here. Adjustable rate mortgages are another, they've gotten bad raps. Now, adjustable rate mortgages actually could work very well for this market right now. We're seeing higher interest rates. And so with adjustable rate mortgages, they typically have a great introductory rate, anywhere between 2 to 4% less than the market rate. And so just keep in mind that the market will adjust the rate. So you have to hedge against that, and you can oftentimes refinance out of an adjustable rate mortgage. We also have foreign national loans. With foreign national lending, this is particularly for buyers that are coming from outside of the United States and they're not residents of the United States. We can get financing for those people as well. So keep in mind, we have alternative means of financing in order to get you lending. Just because you don't fit the general mold of the average buyer doesn't mean that you can't purchase a home with financing. So give me a call. Let me know if you have any questions. And again, this is your real estate advocate coming to you with a golden nugget. Thank you.